After 2014, the focus in the last 10 years on infrastructure has been absolutely massive. If you go to the absolute crux of it, it's basically what risk who is taking.
That for NHAI, the toll income will start increasing significantly now. NHAI has also leveraged a lot, and now the debt on their books is close to say 2.5 lakh crores. So they also need some source of capital.
Generally in infra, why payment is not coming for 90 days means that something's wrong. And 6 months is definitely wrong. I have never seen anything which has gone to 6 months and survived. Then something will blow up somewhere.
I think railways is currently in that phase where we are seeing an accelerated capex.
Actually, in China, there is a huge overcapacity in cement. The Chinese cement capacity a couple of years ago I had checked was 10 times that of India.
If working capital is moving in the wrong direction, that the working capital cycle is elongating, then it means that you are taking wrong projects or you are stuck with the wrong counterparty.
Understood.
Who is not paying you on time.
This is a balance sheet sector. The balance sheet determines growth. The P&L does not determine growth. So what you need to do is that the first question to ask on any project is, do you have financial closure? Now I'll tell you why this is important.
Hi, my name is Shashank Udupa and welcome to HDFCSKY presents Make Money Matter. Now our podcast has got financial experts who will talk about insightful information about different industries in the stock market, and after listening to this podcast, you will be the smartest guy in any room. Now you won't find any podcast like this which has so much depth of information, and this podcast will actually make you one of the most informed investors. So now I want to understand another very big sector, and I want to deep dive into that today, which is the infrastructure space, right? Now, I don't want to get into energy part in infrastructure, but let's talk about national infrastructure and how do we track that space. Now, it is a very big space. So if you had to break it down from what you do with research, because I know HDFC has made a wonderful report on infrastructure space, right? The NHAI way. So I want to understand more from your perspective. How do you break this down when from a fund level?
You know, infra is something which comes naturally to us. Even at the bank, our parent company, HDFC Bank, we have a massive practice in the project finance, where roads, power, things like that, we are very large. It's a core sector for the bank as well as for us. And we actually, NHAI was just one of the multiple reports that we've written over a period of time. Not only that, I think the strategy team also does a CapEx tracker. The good thing is, you know, in the last 10 years, what's happened is that, so there are two ways of looking at it. One is the top-down, as in how the government's looking at it. Clearly, after 2014, the focus in the last 10 years on infrastructure has been absolutely massive. Okay, one, it's also been a proven vote winner. So, you know, the government's focused on that. The other is it actually creates assets for the long term. And the amount of data that is now available for you to be able to track all the major CapEx, projects on a project-by-project basis is also some major work that the government has done on that, which is what, you know, we've been covering in our reports.
Okay.
So one is that it's a key component of GDP, politically very important, and the numbers have just gone up every year. In fact, this year, if you look at the budget, despite the fact that there was elections, so there was a period of time when the CapEx spend was not happening, the full year CapEx number was the same as last year. That's actually a growth. Because, you know, with no activity for 2 months, effectively they are going to do, you know, the government CapEx number for 10 months is going to be the same as last 12 months.
So there's going to be a push.
That's a serious push, and this is something which has been a consistent theme.
Okay.
The way in which you would look at it from the market perspective, however, because finally it has to boil down to stocks, is that, you know, starting from L&T and going downwards, is that one very large, you have to look at what is the investable universe. Okay, and in that, I think the key elements to a large extent are, one, the road manufacturers, the road builders rather. Okay, then there is power. And then there are the, the InvITs, right? So
yes,
there is a new category which we'll talk about. Yeah. And technically even telecom towers comes into in the infra space. So this is broadly...
Defense, railways.
And then there is defense and railways. Okay. In fact, I would say that, the construction EPC as a railway, all of that plus buildings. So all of that, this is basically how we look at it.
So see, broadly, if you look at, there is around 11 lakh crore of spend annually now. This number used to be only around 4 to 5 lakh crore 5 years back. So that has been the extent of increase in government capex spend. This is the government capex number. So if I were to break this up, 11 lakh crore, around 2 lakh crore is roads. similar number, defense and railways is around 2.5. So both have grown again significantly in the last 4 or 5 years. Roads has been at this range of around 2 lakh crore per year for a few years now. It's been more or less in that range. And then you have few other ministries like your water, your urban development is another big ministry, and then metros, and so these are some of the large. So the defense, railways and roads itself is 60 to 70% of the total CapEx spend. So these are the three large sort of segments, and then you have the urban and water and some of the other ministries.
So is it safe to say that I think in the last few budgets, most of it has gone to the road and railway has taken most of it? Is it safe to say?
Yeah, so defense, roads, railways.
And power is separate. Yeah. But if you remove that, a good amount of
even
money...
urban development has taken up.
The water management, beach
no, not just water, but even the whole cities, the new cities, the metros.
The layouts and all of that.
The renewal plan, basically.
Okay.
Then even housing, the rural and urban housing program, that also part of it comes under this. In water, you have that Jal Sinal kind of schemes and all from government. That is also an emerging segment which have become, big. Earlier, Swachh Bharat and, some of those were also there. So it's a whole host of then smaller schemes, but the large ones are, defense, railways and roads.
Okay. Now I have a question on this, right? I'm trying to break it down into more segments. Now, if you look at construction and road and construction, so we have had a lot of airports coming up recently. And we have some big metro lines coming up, even in Mumbai, we've seen that. And we have huge national highway corridors that have been created. 3-4 things, right? And as you said, I think you said in the first part, L&T has a good, the investable universe, I think from your report I read was around 35-36% are listed and 68 or something, 65 is around unlisted at that point, right? So if you look at just the investable universe from this perspective, first question is the construction spends that come, are the stocks very geographic dependent? Like if there is massive construction happening in southern India, then is the investable universe completely different? Or if you talk about, let's say, airports, is L&T doing all of it? Or is Metro L&T doing all of it? So I don't know how that works. So how do I break it down?
Yeah, so the way in which we look at the investable universe, so as to speak, if you talk about infra, is that if you go to the absolute crux of it, it's basically what risk who is taking.
Okay.
And that comes down to whether the company is only taking a contract to build, with no risk of anything else. The second is the company taking a risk to build and then own it, the asset?
Okay.
And the third is that is the company now only owning the asset after it has been built and brought to maturity? So first is the EPC, which is, let's take the example of GR, for example. GR is a company which we cover as well. They can take a contract from the government to just build. But there is also where you can build and own. Now, there are two models in there, which is the BOT, which is where you build, own, and the risk of traffic is sitting with you.
So BOT is build, own, and?
Build, operate, transfer.
Okay, build, operate, and transfer. Okay.
Where the risk of the traffic is actually sitting with you. And then what had actually happened was that when the Modi government came in 2014, at that point in time, they had started to see that a lot of the developers were still undergoing stress. Now, if the history is very important in this one. What has happened is that the first round of EPC and owning of assets happened in the year 2000 to 2008. At which point in time, with the cost of capital coming down and a lot of companies became very large, they started taking on projects at costs, at prices which were very unviable. In some cases, even taking the risk of the raw material. Now, as a result of which the balance sheets across, with the exception of L&T, honestly, number 2 onwards, pretty much every company, either because of their, losing their working capital cycle, or because they also invested in real estate, the stress in that sector was very large. So when the government was trying to push through the scheme of actually developing assets, there were no contractors left to bid.
Yeah.
At that point in time, they realized that one of the big things which needed to be removed was the risk of traffic. Because when somebody has to build the road and then own it, the big risk is whether traffic will come or not. So what they developed was the HAM model, which is a unique model in India. I don't think globally.
Hybrid annuity model.
Hybrid annuity model, in which case the traffic risk, it becomes like a bond. So you develop, there is a, it's a fixed contract where you know what the price is. Some of the raw material risk is also taken by the issuer.
And part of the funding is done by NHAI. So 40%,
Wow.
is done by them. And
actually,
developer has to bring in only 60%.
Okay.
And out of which he takes debt. So his equity is only
so if it's
20% of
50-50.
60, so 12%.
Yeah.
Okay.
So basically NHAI took it on its own balance sheet instead of letting all developers kind of...
So these guys built it and then they take a part ownership in that,
So
project.
it's funded by the NHAI, so they get a part ownership. The construction company owns a little bit of it, the rest being funded by debt. And then because there is a fixed amount that you would get irrespective of the traffic, the gap was actually being filled by the government if it was shortfall, basically. It made it very easy to finance these projects. So even companies which did not have that much track record were able to bid. Now, over a period of time, obviously, a lot of these companies become very large. Now, as with any other model, when somebody puts so much balance sheet and risk on the table, for example, in case of NHAI, right now is the balance sheet got bloated to a significant extent. Obviously, that being a sovereign, so money kept coming. But at the same point in time, now we are starting to see the other end of that cycle, which is that incrementally now with companies having come up to scale and them having developed all of this, we've had two big developments which have happened.
Okay.
One is that, again, a fairly unique concept to India. Of course, there are other countries which do it, but fairly unique concept to India is that if you look globally, whether you look at real estate or any model where the risk perception changes through the cycle of the project. When you have not built, it's a very high risk project. Once it has been built, the risk comes down, but now you're taking traffic risk. And at the last stage, once you know what the traffic is, you are broadly settled. So in this type of case, a lot of pension funds, a lot of global sovereigns, even mutual funds, realized that they could use that annuity, so they could recycle the capital. What that meant is that if GR Infra, for example, has built a road and has got now a portfolio of HAM assets, HAM as in the hybrid annuity, and is getting a steady flow out of that, it's a bit like a bond. There is some risk to it, but it's a bit like a bond. So what you could do is you could take that entire cash flow, put it into units and actually sell it to there. What had happened in case of mortgage back was the fact that the underlying asset was not very well monitored. Okay. The other was that when you talk about, actually MBS is not a bad product. MBS even today exists, including in India.
Yeah. They mixed it too bad, right? I mean, they
mixed too many things. There was too much risk and the default risk was underestimated.
So this, what you're talking about today, what is it called?
So it's called, it's an InvIT.
InvIT. Oh, that is what InvIT is called.
Yeah.
InvIT. So InvIT is basically a developer, right? So he has to put in that capital to get any new project.
Yes.
Right? And nobody has an infinite capital.
Correct.
Right? Because these are all chunky projects. So effectively, the process is you keep selling the assets simultaneously. Whatever you have built and now it has become steady state. So the developer risk is gone. And now it's a steady state yielding sort of
the road can be seen.
That you had invested 100 crore and it's every year giving you 10 crore. So 10% kind of a yield is there. You just sell it for a certain amount.
Let's say 9 times of
Understand.
It will be valued like a bond. So you sell it out 900 crore. With that 900 crore, you now go and bid for new roads.
Okay.
Because you are a developer.
Yes.
You are not a asset road owner for the long term. Because then there is no skill of yours which is coming to the fore by keeping it on your own balance sheet.
And does he still have that property? Is it still owned by him, that project?
Which one? No,
the earlier one?
The InvIT will be owning it. So you sell it to the InvIT.
Vehicle that owns it.
Yeah.
Okay, got it.
It could be same company floating a InvIT also, like GR Infra. They also have a InvIT.
Called Bharat InvIT. It actually is listed in the
So they will keep pushing their projects into that InvIT as they reach completion and they become steady state. And you recycle that capital to go and bid for newer projects. Otherwise, you will be stuck with...
So it frees up the capital to actually go... Wow.
Yeah.
So it's like at a time you are building, you can build 10 roads. Now, if you don't sell anything, you will be landing up with a portfolio of 100 roads and all the capital stuck there. So for you to recycle capital, you need to keep selling it to InvITs, and there are enough, as he said, pension funds, long-term sort of providers of capital who want to own these kind of
How many
assets.
InvITs do we have right now in India?
So in roads, you have the NHAI InvIT is
Then
there.
you have in power
and then
also.
In power grid
Power
InvIT is
grid
there.
InvIT
Oh,
is
even
there.
NHA is offloading their balance sheet to InvIT, and
There is a listed InvIT by NHAI as well.
okay, wow, this is very
Then you
interesting.
have in power, you have IndiGrid and power grid.
Power grid InvIT is there.
So
In fact, there are new getting filed as well as we speak. So
And what about the other companies? For example, we have these IRB, the companies that actually manage the toll revenue, as you call it, right? I think this was something that was there in your report with that NHI report that I read, had a lot of incremental toll revenue that was increasing over different periods with CapEx.
that for NHAI, the toll income will start increasing significantly now.
Okay.
So the point that he was saying was that NHAI has also leveraged a lot, and now the debt on their books is close to say 2.5 lakh crores. So they are also
Wow.
not able to be a partner in too many new road projects. So they also need some source of capital, right? Continuously recycling of capital. So with them, toll revenues increasing in the next few years significantly will provide them an income stream, which again they can put in an InvIT and monetize.
Got it. Now, I want to ask a question on rail, right? Because this is something that has been making the buzz a lot in the last 3-4 years when I think Vande Bharat was announced at that point. And obviously, rail needed a massive revamp, right? It was, I think, something that we could never make it very profitable and very attractive for anyone to come into it. Now, how is that playing out in India? And is it very cyclical? Is it like something that's happening today? Or do you feel that this was something that was supposed to happen, is happening right now because... How do you see that playing out? Because I know there are themes of electrification for so many kilometers, number one. Then we have Kavach systems being built on the other, which is proxy. Then we have the actual guys making the coaches, right? And so how are these playing out in your head? Like, what do you think about this segment?
So see, railway capex, as I was saying, has increased significantly, and it typically tends to happen in chunks. Like, the whole capex thing in any segment is not as structural as consumption, which is more steady and keeps happening every year, whereas infrastructure spends tend to happen in chunks.
Understood.
And you will have a 4 or 5 year period when government or private sector will come and invest a lot. Then because it is inherently cyclical and the balance sheet risk and all start increasing, then it would have to slow down necessarily. So it's capital guzzling sector.
Yes.
So whenever say capital availability becomes a issue globally, it will slow down. Execution, it's a sector where execution risks are heavy, right? Because any delays or time runs, cost overruns will significantly impact your IRR. And these are very, I would say, low margin and low margin of safety is there when you are bidding for such projects. It's not that you are earning huge margins and
Correct.
a 2-year delay or a 15% cost escalation, which was not built properly in your contract, can completely wipe out your profit.
Okay.
So it's a fairly tough business. Like,
Yes.
all infrastructure segments, by their inherent nature, are far more riskier and tougher compared to a typical consumer business. And therefore, they tend to be slightly more cyclical. When going is good, when markets are supportive, capital is available, you will see more of them. And obviously, the government push also comes in certain spurts.
Yeah.
Because if the revenue collection is good, then government can come and spend. But once say a fiscal deficit is increasing or something, then government will have to slow down. So therefore, I think railways is currently in that phase where we are seeing an accelerated capex. In the last 2 or 3 years, and probably it will continue for next couple of years as well, because there are still some well-identified projects and all which will continue to see good capex over next 2 to 3 years.
So what are some of the interesting companies that you have seen in the past as case studies, if you want to just give like a case study in the infra space? It can be anything in the infra space, but this is something that you found was बहुत interesting था, the business model they adopted was interesting, or the way they executed something and turned around their business is interesting, because you've seen the cycle before 2008 also, and you've seen the slump of infra, and now you're seeing the growth of infra. So we have not seen this. So how would you, is there any case study example of any company that you have seen how they pivoted or changed or something like that, even like a small...
I can take the case of GR, because that's the one we firstly we cover, and then that's also... We were also bankers when they went public both times. They, I think, got the big advantage of the fact that they had learned from the past mistakes of the others. I think the two big issues which created the big infra slump from 2000, around the global financial crisis was one was too much ownership of assets, including real estate.
Okay.
Where honestly, infra companies had no business doing that. These guys, firstly, did not do any of that. The second is that actually in infra, especially when you're a builder, basically a construction company, working capital is absolutely paramount. And the second part of it is that big risk that you run is acquisition of land. And then the second risk is that, assuming all of that is in place, is the fact that is your raw material completely under your control? Because what happens is that land is a state subject. Well, the National Highway is a central government authority. So you're actually dealing with a lot of people, a lot of different government agencies. And, if you are in Bombay trying to develop the coastal road, then the water will going to be provided by BMC. So you're talking to 3 different agencies just like that, just on day one. So some of it is credit to the government because a lot of rules around land acquisition at the start of the project of, let's say, 70, 80, 90% across projects was a decision which was taken by the government. Because there have been cases in the past where you started a project and the land never got acquired. So everything got
money is
delayed.
blocked.
The reason why the developer took it is because for getting the order inflow, you were getting market cap in the market. So they took it anyway. Because anyways, you were making money there. So that got corrected. That was the first. The second is that this company also realized that a lot of aggregate, those small stones that you put under roads and things like that, aggregate is basically all the stuff which is the raw material for making the land. It was basically under their control. So backward integration, which increased the margins also a little bit. The third, I think, very interestingly they did was, and to give them credit, is the fact that they did not go out of their home market till the time they figured out the exact process. What happens is that, just like real estate, the local government coordination to understand the nuances of how things work in a single state, you'd rather work in that and neighboring states to first get your model absolutely right.
Become a king there.
Yeah, you first figure this out, get it right, your costs come down, you can your management bandwidth does not get taken away just traveling across sites and things like that. I think that was the other thing. And the last one being the most important, which was the big blow up which happened in the previous cycle, was all working capital receivables. The money was not coming on time. I think what happened was that partly due to the government, and because of selection of projects, either NHA or border roads, right, BRO, they did not take many state level projects to start off. Of course, that changed over a period of time because some states were behaving better than others. So selection of project was something which was very critical. And at the right amount of time, when it felt like they had reached a scale, I remember the market cap was 8,000 crores, they actually went ahead and did a listing. So the first round of capital comes in. Now the company grows a little bit more. Now you have a portfolio of HAM assets. Now you are financing them using the bank. They took a portfolio of that and they listed that separately as Bharat InvIT, which happened last year. So, consistently what has happened is that they have made themselves into a scalable model, which now can lead to, as he was saying, the next round of investments into projects. In fact, I believe that with the government now, where the NHI balance sheet is a bit stretched, what will start happening is that we will go back to the BOT model, where the government will say that the developer has to share the risk with us. Now that so many of you have taken off and become large because of the moves made by us in times of distress, now you find that companies like them have got a balance sheet, have got the track record to be able to manage that risk as well.
But won't we go back in the same cycle? Again, the stressed balance sheet, aggressive
invariably
CapEx.
there will be somebody always blowing up. But the government cannot continuously keep underwriting risk.
True.
Okay, it's a bit like, in fact, your MBS example, where when blow up happened, government actually had to buy those bonds. That is not how it should be. Risk should finally be a private sector risk. And it can be shared with the government. Okay, and if if whatever is in the government's hands is taken care of, then the remaining risk should be yours. And for that, the return should be commensurate. That does not mean you bid cheap. Will there be cycles? Of course there will be, right? There will always be certain states where something will go wrong and stuff like that, just like it happens in the banking sector. But in general, if you think about it, then I think that's the direction we are going in. And this is a case of a company which has built their balance sheet strength up to a point where maybe a little bit more risk can be taken now. And the beauty is that can also be pushed into the InvIT. So a ready vehicle available to absorb all of that incremental is also there.
So I have one more question, which is, I think you mentioned something about this with respect to, let's say, raw materials, right? So I want to ask a question on that front. When you look at the infrastructure space, a proxy that we consider in infrastructure is cements. And there's a lot of movement happening in cements with, let's say, Adani buying 2 companies. Now, Ultratech did the biggest CapEx that they ever did. They also took controlling interest in India Cements. So what is happening there? Why isn't, I don't know, I might be wrong, but is too much CapEx also bad? Like, will so much capacity be a problem? Or do you think that the demand is there to sustain this supply that will come from the cement companies?
So see, cement, from an industry dynamics perspective, I think from the long-term perspective, things are moving in the right direction. Because while you are hearing a lot of CapEx, if you see, it is concentrated among the top 5 players. So the sector is becoming increasingly consolidated, right? So earlier the share of top 5 players in cement sector used to be fairly low. Now it is upward of 50-60% in terms of just the top 5 players as a percentage of total all India cement.
So revenue migration
capacity.
bhi hoga? Matlab from the lower
because
players.
once the capacity, because it's only the large players who are able to add capacities. For a lot of smaller players, the balance sheets are stretched.
Yes.
So in that way, they will either get sold out or they will stop expanding at least and just focus on existing operations, whereas the large guys have the strong balance sheets as well. If you look at Adani's, you look at Ultratech, even the Almia Bharat has improved its balance sheet. So now I think the top 4-5 players only will keep adding capacities, and therefore at an aggregate level, we are not in a situation where we are seeing significant overcapacity.
Not yet there, okay.
Not yet there. So and growth is quite good because cement caters to both consumption, which is housing, plus your construction. So it has blend of both. And so therefore, even if one goes down a little bit, the other one compensates for it. So therefore, cement growth, demand growth should be in mid to high single digits. And supply is also in the similar range only. The value of cement versus the transportation cost. You can't produce in south and sell in north. You need to have local sort of plants because it becomes unviable from a costing perspective. If the transportation logistics cost is a very big component of the total cost. And therefore, there are regional players always that a south guy would have a plant in south and keep selling in south. A north guy would be operating in north. It's only now that obviously the large companies have got pan-India presence. But they also have plants everywhere. So, but at the end of the day, it always remains a slightly regional industry that also protects it from the fear of imports, which is there in case of metals. Typically, you see that in steel and all, there could be a lot of imports from China, but you would not hear it in cement because the transportation and logistics cost versus the cost of cement is a fairly high. So it's always a local, national kind of a industry, unlike some of the other.
And interestingly, that is despite the fact that actually in China, there is a huge overcapacity in cement. The Chinese cement capacity a couple of years ago, I had checked, was 10 times that of India. Of course, they have absorbed a lot more as well. But at the same point in time, and there the companies, especially the unlisted companies, are actually at a 2%, 3% margin.
That low?
That low, yeah. So if you ask any global cement analyst, actually cement analyst as hota nahi hai, lekin
infrastructure,
global infra analyst or someone who's looking at building materials has always felt that cement is, actually, cement inherent nature is a very, very low value added product. It's just limestone converted into...
No innovation also.
There is nothing. No, but there is an element to it. But what happens is that actually there is not much to it. Literally, we could build it in a small plant in our backyard. It's that simple. The issue is actually that the input is not limestone. The input of cement is actually electricity. You have to be able to make it.
Okay.
So what happened in China was the fact that the electricity costs were low because they were subsidizing all of this for all the build out which was happening. So the cost was very low, and then everyone thought we can operate on a 2-3% margin. But because the freight cost is high, they cannot export that anywhere. Now that the build out is going down, a lot of cement companies there are also consolidating. In India, what had happened was that it was always a consolidated industry. In fact, you may remember that in 2000, was it 8 or 9, there was a huge competition commission had stepped in to actually, because they thought that there was a collusion was there. That obviously is not there anymore. But at the same point in time, what has happened is that because of the consolidated nature and the fact that scale gives you cost advantages, the return ratios are still quite interesting. Incrementally, however, what is happening is that is not leading to more competition coming in. Primarily because of the fact that cement is the second largest polluting industry globally.
Oh, I didn't know this. Okay.
Just because of the sheer amount of electricity they use. So it has become mandatory to do waste heat recovery, for example. It is, as in the state governments as well as the central governments have been pushing. And the electricity use, they now want to convert. In fact, recently there have been a lot of innovations which are happening in trying to build cement differently. Just recently I was reading some papers that there are a lot of studies going on in Europe trying to make cement in a different manner, to use less electricity than what it is today. Now, when that level of CapEx is going to see, and India has committed to zero carbon at 2070. If the second largest industry is going to remain like this, there is no way we will achieve that. Which means a huge CapEx cycle is about to come. Now, will that happen next year? I don't know. But let's assume that, because Prime Minister Modi has committed to this, right?
Yeah.
So what will happen is that progressively with waste heat recovery being the first part. In fact, 2 years ago, our analyst had written on this.
What was it? Waste heat recovery.
Waste heat recovery. What it says is actually when the slag comes out, basically it still is hot. You can recover that heat to build more cement.
Basically reusing the heat to basically,
okay, for the
reduce your energy consumption.
To reduce your energy consumption. It makes a marginal difference, but at that scale and with the growth that is coming. So what is happening is that the consolidation will also continue to happen because of this reason. Because the incremental CapEx, the capacity for a small plant to do that will not be there. In fact, this year, Sanghi has gone, India Cements has got sold. I think there are
smaller players are finding it.
Yes. No, I have one. I still have one confusion though. Like, let's say, I come from the normal retail investing background, right? I see the budget. I understand itna abhi infrastructure budget aa gaya, theek hai? I don't know where it is going, which country. Now I think two cities have been named that we will have so much CapEx, but earlier that was not the case. Number one, I don't know where this CapEx is coming, so I don't know where to streamline my approach. Now, as a retail investor, how do I take advantage of this? How do I understand? How do I break it down until my stock? From sector to stock, how do I reach here?
One is, infrastructure, you have to start top down in that sense, right? Because first of all, there has to be allocation towards that segment. So one is you look at, where the incremental money is going more. Is it roads, railways, defense? Then it comes down to who are the leading players. Again, this is a segment where, the larger you are, the better it is, right? Something like L&T. A very diversified portfolio across different segments, large balance sheet, your ability, because this is a balance sheet business, right? So the greater or stronger your balance sheet is, the better are your chances to ride through the cycles.
So is it correct to say that the larger players usually absorb most of the budget?
Yeah, because their capacity to go and bid for larger projects is unparalleled or much superior to those of the smaller players.
And is it good to do proxy investing in this? Like find who, let's say L&T
so I think the top-down approach so for India overall CapEx story, you can have L&T because it is present in almost every vertical and is a leader in most of them. But then some railway-related CapEx would be certain players like, say Siemens or Alstom or, those kind of players. Then power transmission would be slightly different like KEC, Kalpataru. So if you believe that power transmission, which is another segment which is seeing a lot of CapEx, and especially the renewable, transmission, then it would be a different sort of players which will come in that segment. Yeah. Because in this, there are very few players who straddle across segments. You typically have segment leaders.
Correct.
That KEC Kalpataru is more on this segment. Somebody like for roads, you will have different kind of players. Again, there would be some regional road players, as you said. It's a regional industry at the end of the day. So if you want to play road construction in UP, Bihar, then there is a set of players. If you want to play in Andhra and South, then there is a separate kind of player. So it's more top down, and then you just do a sort of you have a look at the fundamentals of the business, that whether that company's balance sheet is fine and what is their historical track record in the previous cycles. I think in this, that becomes a fairly good benchmark for you. that if the company has survived some of the previous down cycles, then they have the right discipline in terms of bidding, in terms of managing their working capital, because these are the two most essential things in an infrastructure company.
Yes.
The discipline in bidding, and then how they manage their projects and working capital. If these two are taken care of, then they should be able to ride through the cycles. So you look at the past track record in infrastructure becomes very important.
Okay.
Like, betting on somebody new who has only seen the upcycle,
That would be risky.
that would be risky. And then you identify the segments you want to kind of focus on, look at the leaders of those segments, and just see that their balance sheet and historical track record in those segments is good enough. And I think that's the way to kind of do it.
And there are some long-term trends, like for example, waste heat I was talking about. Even if you look at the energy cycle, for example, as of right now, if you look at, I'm talking very simplistically, but if you look at the map of India, generally all the coal is sitting in the center. And what's happened is most of the large power projects, coal-based, have come broadly around that. Because again, same thing, transporting coal and then making electricity, you'd rather make the electricity and transport it over the line. Now, 10 years ago, they would do this far away from the pit head because you could transport the coal at very cheap rates. And then there were no transmission lines. But with a power grid over the last 15 years, having invested so much in transmission capacity, pit heads became very important. Basically, you dig the coal out, don't transport the coal, you build the electricity and transport the electricity. Now, however, what's happened is that with coal basically going into a long-term decline, maybe not right now, but in a long-term decline, the other interesting sources of electricity, which are all renewable, are actually not in central India. So what's happening in power transmission, for example, is that if you look at, again, I'm talking slightly simplistically, but southeast is basically where most of the big wind projects have come.
Correct.
While north and west, basically Gujarat, Rajasthan, all of that is where all the big solar has come. So the cycle has completely inverted itself. If you look, it used to go like this. Now it is coming like this. So, and then obviously the regional player there becomes important. So, this is actually a sector where you need to be very bottom up as well. You actually check the company's upcoming projects. And that will give you a sense as to whether this makes sense or not.
But इसमें एक problem है. So, I have seen companies with crazy order books, mad order books. ठीक है? आधा time तो stock price ऊपर जाता है order book के हिसाब से. But वो execution of the order book becomes the biggest concern. And yes, they do get the projects, they get the order book is inflated. I remember recently I read about a company where order book is more than the market cap also, right? But then when you see next quarter, the execution is horrible. Sometimes maybe okay, sometimes really bad. So वो order book लेके करेगा क्या? So how do we understand
so
this?
I think order book growth is an important metric in this sector.
Yeah,
You have to look at order book growth, but only as long as, see, order book is meaningful only if it is, say, up to 2, 3, 4 years, right?
Yeah.
Any order book beyond that is not of that much significance because a lot can change in that interim.
So focus on 2-3 year order book. Okay.
Unless the company is improving its execution capability commensurately, that their ability to kind of execute projects and book that revenue, that order book becomes meaningless. So we tend to look at order book to to billing ratio as well, or order book to revenue.
Billing ratio or revenue
or
ratio.
Order book to revenue, just to see that. So certain infra companies are short order book. The order itself, the length of the order also is a function of how this ratio would be.
What is a good ratio number?
No, again, it's different for different segments. So something like a ABB, Siemens and all will not have a very long dated sort of a order book. But something in the oil and gas or some of the other verticals could have a fairly long sort of duration order book. So they would have probably a 3 to 4 years kind of a order book to revenue. Whereas in some of the other we call it short cycle sort of companies, it would be 1.2. But that does not matter. As long as they are able to grow their order book at 20% and revenues at 20%, then even a 1.5 times order book to revenue is fine.
Understood.
So it's not that you want to maximize that order book to revenue, but you have to look at you have to look at ratio, and you have to look at growth in both order book as well as revenue.
See, if order book is only growing,
if one of them is growing, you have an issue.
Yeah.
And the other is not growing, then you have a problem.
There is also a very interesting predictor actually of this, because see, the big risk is again the blow up of the working capital cycle. The simple thing is, when you assess a company bottom up and you ask them for the list of their projects, which they are mandated to disclose, What you have to look at is who is the counterparty. That makes a huge difference. Every state government as well as central government, whether it's NHAI, BRO or the state government, you have a track record. Okay, you can trust that generally things don't change beyond a point. Now, if you look at that, there are two outcomes which will come. One is that they have taken a project in a state where it does not have a great track record of making payments on time. And generally, rule of thumb is that if there is a working capital cycle of over 90 days, then you go in and check what has happened.
90 days.
Yeah, it's just a rule of thumb. See, there is no science to it.
Yeah.
89 is not better than 91, right? Yeah. But at the same point in time, if it's more than 90 days, this is across sectors, but generally in infra, why payment is not coming for 90 days means that something's wrong. Okay, so that's a good rule of thumb to keep. And 6 months is definitely wrong. I have never seen anything which has gone to 6 months and survived. Then something will blow up somewhere. The other, which is very interesting, is actually the first question to ask. And because, he alluded to that, he was talking about the fact that this is a balance sheet sector. The balance sheet determines growth. The P&L does not determine growth.
Very interesting.
So what you need to do is that the first question to ask on any project is, do you have financial closure? Now, I'll tell you why this is important. If you look at the big blow-ups which happened in the banking sector, because this is related to what happened in the banking sector. You had big blow-ups in the PSU banks in 2001. Then you obviously with the global credit crisis. Then in 2013, there was a very serious crisis that we went through. And then the ILFS crisis of 2018. What happened from 2015 once Raghuram Rajan became the, the intent was there from the government, but when Raghuram Rajan came in and became the, we went through a cycle. In fact, because I was also at HDFC Bank at the time, we've gone through a cycle of tough love from the government. What they've done is that, one is that the monitoring from the RBI on individual projects has gone up significantly.
Now, today?
Yeah, in the last 10 years.
In the last 10 years.
Because he came in 2013, I remember, in October. That's when he got appointed. Or September maybe, something like that. And then he was there for a term, 2 terms basically, or 2 terms, right? Oh, yeah, something, for some few years.
5 years.
So 5 years. So what happened was that in that period, they started with IBC. They tried a lot of different models and finally came up with the IBC, which is basically equivalent of the bankruptcy code. Yeah. Now, what happened as a result of that is the monitoring by the RBI on every single loan exposure went up significantly. Their core view was that we cannot allow a big blow up in the banking sector to happen, especially on the corporate side. Retail side is still, because diversified, so better taken care of. Now, what happened and then the second factor which came in was the fact that a lot of the small PSU banks were merged with the large PSU bank. So the RBI also had a lower problem to deal with because they had to only monitor a few number of banks. Now, because of this enhanced monitoring of every single project, which is happening from the RBI's level, if you delay something by 30 days or more, then, the bank comes under severe scrutiny. So a lot of lending practices which existed before 2014-15 have slowly over a point in time gone. Today, and also in the PSU banks, where they were more prone to do this, and there's a historical track record of them having blown up so many different projects, is that actually the loan approval has come under the vigilance officer, vigilance commission, which means that someone can go to jail for giving a long loan. You can make a mistake and something goes bad in the loan, but you cannot, obvious corruption has been rooted out, basically, of the bank process. As a result of that, what happens is that if you go and ask a company that you have taken this road project, do you have financial closure? And they say, yeah, we have financial closure from, let's say, Axis Bank, HDFC Bank, State Bank of India, and Bank of Baroda, let's say. You know that someone has evaluated the project with a lot more detail. Because look, public market investors can have only so much detail, but that does not restrict the bank from taking more details from the... So how much land has been acquired? What will be the capital requirements? Who is going to pay at what stage? What are the guarantees? Who is writing the,
So can I see this like a retail investor?
No, the banks. But the question that can be asked is, do you have financial closure or not?
Okay.
That question is very fair to ask. So let's say, okay, to give an example, someone has 5 years, order book to revenue ratio and says that I have taken a 500 kilometer project in, let's say, Rajasthan. Just throwing a name. And you go and ask them that where is this project to and from? You know from the 2 cities what it must be about. Because they'll tell you that there is this, this mining is there and so on and so forth. This is where the traffic will come from. All those project reports are available in public domain if you really want to read it. But if you ask them which bank is funding it, and they say, I don't have financial closure, then you have to discount that and wait for financial closure to happen because the banks would have scrutinized the project.
Okay. Understood.
So that is one very nice way of figuring out whether this is credible or not, this project.
Now, to a last question, because we spoke about balance sheet a lot. My last question is, there's a debt to equity ratio, which is the balance sheet, which is the borrowings to the equity or reserves, right? Equity plus reserves. So when you say balance sheets are bloated, what is that debt to equity ratio? Ki borrowings are so much above. Do you compare it via debt to equity?
Debt to EBITDA.
Yeah,
Debt to EBITDA.
Net debt to EBITDA.
So when is it considered bloated in your opinion? When it goes beyond what threshold?
Typically, anything above 2-3 times becomes
3
very
times net debt to
difficult.
EBITDA?
Yeah.
3 is bad.
3 is on the
above
higher
2
side.
is
I'm
when
saying
you start
anything
looking
above
at
2 is a red flag.
Okay.
Anything above 2 is a red flag.
Wow, this is something new. Net debt to EBITDA.
But 3 is definitely a concern. There has to be a clear reason why it has to come down.
Okay.
As in, there must be a short-term reason. Because see, what happens is balance sheets are one day in a quarter or one day in a year. There could be some specific reason why it has gone to 3. But then there has to be a very logical explanation as to why it will not remain at 3.
Yeah, and some revenue visibility that comes in your
3
revenue.
is okay in that sense, but you need to know why it will not stay there.
So one question from each again, right? One good thing that someone should look at in this space from a retail investor perspective, and you will tell one bad thing that they should be aware of. Like net debt to EBITDA was one of the things. If there's anything else, that one bad thing that someone should look at before investing, ki ye boss check karo, without that you cannot go. And you should say that one good thing about how retail investors should look at, right? From anything, it can be anything in the value chain of infra. Something that is from a positive light. Anyone can go
Negative
first.
so easy.
I think
Positive bhi chahiye.
No, so I think on the positive side, I would say order book growth. So which is effectively tells you that this segment has a tailwind.
Yeah.
कुछ
Right?
हो
So
रहा है.
opportunity is there. Now whether you have the capability to tap onto that opportunity is another question which you need to answer.
The counterparty, I think, is the important one.
Counterparty as in?
Are you dealing with the right counterparty? Because you could be building a road for a state government or even a small municipality or a Gram Sadak Yojana, or it could be for the border roads, or it could be for NHA. So what he's saying, I'm just adding a layer to it. Saying
Is it
who's
better
the
to have
counterparty?
a higher like a credible counterparty,
Yeah,
like
so
NHA?
which will get
closer you
reflected in
get
the
to the sovereign.
which will get reflected in the working capital. So the negative point which I was talking about, apart from the debt, is the working capital. I think working capital monitoring of a infra company is extremely important. If you just look at the track record, if working capital is moving in the wrong direction, that the working capital cycle is elongating, then it means that you are taking wrong projects or you are stuck with the wrong counterparty who is not paying you on time.
And are you still tracking infra? As you said, HDFC tracks infra a lot. Are you guys still tracking infra?
Yeah, it's one of our largest stocks.
Okay, perfect. I think that was a wrap for today's episode, but very good insight about the entire infra space. I think some of the key learnings that I would outline is, number one, this InvIT thing was something new for me. I knew InvITs were there as an instrument, but I didn't know this was how they offset the balance sheet to reduce the load, number one. Now I know how important toll revenue is also, because it's literally made it into an instrument. So now I think we should not cry when we go on toll roads. Third thing, what I liked about what you said is the net debt to equity, right? Because net debt to EBITDA. Because I think a lot of us look at debt to equity ratio on screener, like we use that and we say, acha, jada ho gaya, so now it is going to become a problem. Eventually, he either raises funds or he reduces the debt in some other way or refinances it. So this is something that is very good because it shows the ability of the customer to pay. And for all the people who invest with FOMO, what I would like to tell you guys is, Sirf order book mat dekho. I think that is something that a lot of us just look at. Acha, 3,000 crore order, 5,000 crore order. People are buying upper circuit, everything's happening. Look at the execution and it should be in proportion, right? Aisa nahi ki wo 2 lakh crore order book hai and he's executed like 20-50 crores, right? So look at both, as you said, in tandem, and that actually helps you a lot while making investment decisions. Awesome, Unmesh, Varun. I think this was a wrap for today's episode. So again, thank you for this amazing insight into the entire infra space. Now, for all the people who love this podcast, I have something very interesting for you. If you are looking for a career in finance, then HDFCSKY is actually offering an internship program mainly for the people who are watching this video. Now, how do you apply? Very simple. Fill out the form that is in the description and also comment today about your take on this entire video. Now, I want you to put all your thought into this and do your research and fill out the form, because I don't want you to miss out on such a beautiful opportunity of doing an internship in one of the biggest security companies in India, and also what you get is crazy amount of knowledge. So don't miss out on this opportunity. We're giving it to you, so it's up to you now to take it.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.